Hello, folks. This is Dave Gilreath at Sheaff Brock Investment Advisors. Remember, we are the firm that uses innovative portfolios for intelligent investors like you. So today we're going to talk about ETFs, exchange-traded funds, what they are, why they're getting so much more popular, and what you might want to look for. So an ETF, what is an ETF? An ETF, according to Investopedia, is an exchange type of a security that tracks an index, tracks a group of stocks, tracks a commodity, and it can be bought and sold on an exchange just like a regular stock can. It can track any number of different things, and there's a lot of them out there, and now they can even track specific portfolios. So the first ETF that came out was the SPYDER, SPY, and that tracks the S&P 500. That came out in 1993, so we're almost, 30 years into it now. Now there are over 2,500 ETFs listed in this country, and there's a lot more than that listed outside the United States. So they've become a very popular form of investing. The first actively managed fund, because up until 2008, all of them were index funds. They would track specific indexes, whether it was the S&P 500 in general, or whether it was sectors or small cap, large cap, whatever. And then in 2008, Bear Stearns launched the first actively managed ETF. The reason no one remembers it is because they launched it the day after JP Morgan basically was forced to buy them in 2008 when the world was ending in the financial crisis. And it came out on that day after all the news of the Bear Stearns being shut down, basically bought out and shut down. And then it only lasted a year after that. And then there was another decade or so that went by before another one was even issued. But money has been flowing into ETFs, but it's been flowing out of regular mutual funds for years and years. And you can see that over the last 5 years, there's been multiple trillions moving out of mutual funds. And what's interesting is that green arrow shows the last 2 years that's even been coming out of index funds, index mutual funds. And where it's going into ETFs. So the monthly net flows into money going into ETFs is on this chart. And you can see it's basically positive every month, with the biggest month ever being December of last year. Now, what's interesting is that money always was flowing into index or into bond funds for ever. I mean, more and more money goes into bonds and stocks by a long shot. But in the last year plus, more money has been flowing into equities and instead of bonds, which I think is pretty interesting. So ETFs as a group are growing quite a bit. They've raised over $900 billion in new money just last year, and that was a new record. The year before was the previous record, $500 billion. So it's really gone up tremendously. And new ones have been coming out all the time. About 500 were launched last year, more than mutual funds. And now 60% of the new ETFs that are coming out are actively managed instead of just tracking a certain index. And about 800 of them now are actively managed funds. So why are ETFs as a group growing so much? Well, the SEC changed a rule in mid-2019 that makes it easier to launch an ETF. And that's a long discussion that we don't have time for today. But it just got a lot easier and cheaper to launch them. ETFs are more popular because generally they have lower management fee. They're more tax efficient. They're easier to buy because you can just point and click and buy them just like you do a stock. And now with zero commissions at most brokerage firms, they're cheaper to buy than a mutual fund even. So one other reason why ETFs might be getting more and more love is that active management is becoming more and more popular in the ETF space. And as the gentleman at Morningstar said, investors are finally getting it. There are funds that actually do beat the market, and now they can be bought as an ETF. So there you have it with ETFs. Thank you for listening. We will be back with you next month.